let's talk some stocks, because when you were last on, we talked Snowflake. We knew the earnings were coming. You had said you were still a huge holder of it personally, but no longer in your public fund. My goodness,
Yes.
what's your reaction to this? All you can do is chuckle when you look at moves like this. What's going through your mind when you see that?
First and foremost, when I was on your show, I think you remember that I said, Scott, I think it was about 2 weeks ago, I said the data infrastructure companies like Snowflake, Databricks, and ClickHouse, they're all in the token flow. What do I mean by that? As more tokens are consumed, it accelerates their core data business. I suggested I thought they would have a great quarter, and wow, they had a blockbuster quarter. Hats off to the team at Snowflake and to Sridhar for doing this. This is a very different story than software apps like, for example, Salesforce, that more directly compete with the AI model companies. But if you peel back the covers on what they reported, 33% growth, accelerating growth versus consensus of 27% growth. They took up their full year guide by more than their Q1 beat. And the massive beat really came from these two trends. AI is accelerating their core, more tokens, more faster growth in their core. And number two, their products like Snowflake Intelligence and Cortex Code hit a critical mass in Q1. So I expect this growth to continue. We're seeing it as well in other companies that we own, like Databricks and ClickHouse. But Snowflake continues to be a very, very large personal holding for me. We moved out of it in the fund, Scott, because I'm in the business. I have to manage this stuff. Year to date, Snowflake is up 10%, even including today's moves. Compare that what we moved the money into, like Micron, which is up 200% year to date, or ARM, which is up 200% year to date. So for our investors, for our shareholders, that was the right thing for us to do, even though today is an absolute spectacular, well-deserved blockbuster day for Snowflake.
So a couple things. So you're not taking any profits, for example, in the Micron, given the crazy move that we've even seen since we last spoke, just as you said 2 weeks ago. Let me deal with that first, and I have another question about Snow and Databricks.
Right. So yes, we are actively managing our portfolio, Scott. I can't give you every tick and trade, but I will say with these parabolic moves, we absolutely are making sure that we're taking down some of our exposure in names that exceed our price targets, rotating it into other names. But remember, on the All In Pod, we have this phrase, let your winners run. So a key in this business is that you got to let the best companies continue to compound. You've heard me say it on this show before. A simple heuristic for the people watching at home. Think about managing your portfolio in three sizes: small, medium, and large. Okay. And when things are all washed out, when everybody's despondent like they were earlier this year over the start of the Iran war, maybe you take the
latest Fed shock and the new regime that we're dealing with, and what specific technical indicators are telling you that this recovery could be built on a somewhat fragile foundation.
So what's interesting is I think maybe up until the last couple days, that had been a theme, right? It had been very much semiconductor driven, and we'll show some charts in a moment that kind of shows, that performance, 85% up this year in terms of the semiconductor index. We have seen a little bit of broadening though, and I think today was an important day because you had GDP come out beating estimates. You had PCE, which is the Fed's preferred inflation gauge, and that came in a little, basically in line, still at 4%, but for the most part, I think because it came in line and didn't exceed, markets took that as a good sign. And you had some personal income and personal spending data that came in a little bit higher as well. So, overall, and then you pair that with jobless claims that basically came in line, the economy's in good shape. So I think that led to a little bit of broadening today, but whether or not that continues going forward, I think it's going to be hard to tell. I think what you need to do is you need to continue to see rates come down. If rates do come down, you'll probably see more of a cyclical trade going forward, which would benefit things like financials, benefit things like industrials. Some of those sectors, just the last couple of days, Molly, they've really started to pick up quite a bit as the data has shown that the U.S. economy is in a pretty good place.
Yeah, I have this conversation with Alex Coffey nearly every day on Market on Close. We take a look at how the broader market is performing against the big names, but the semis are still dramatically outperforming the broader market. I mean, what is driving this move that seems unstoppable?
Earnings, and more earnings, and then let's add Micron earnings on top of that as well, too. I mean, blockbuster numbers, just crushed it. I think heading into that earnings print last night, there was a bit of fear. I mean, we saw the 13% sell-off heading into the close on Tuesday or on Wednesday, excuse me, and then we get that just a blowout number, and it felt like the market just took a collective sigh, right? And then here's what happened. We open up and everything's up, and then we started to roll back. And why did we roll back? And I think this chart it tells quite a bit here. A 90% move from year to date in the semiconductor index, but the Mag 7's not participating, and that has been the structural driver of the market for 3-4 years now. It's all anyone ever talked about, and I think there's a couple things that are at play here. For the longest time, the Mag 7 was really the trade of choice because of a few things. They had wonderful balance sheets. They were very cash rich, generating cash and cash flow at a really high clip. Well, now we're seeing different types of financing. We're seeing them not only issue shares, we're seeing them go to the debt market, and we're seeing them use a lot of that free cash flow as a way to add about $750 billion in terms.
Wall Street may be looking at AI completely the wrong way. Everyone keep asking, has the AI boom is peaked? But the companies actually building AI infrastructure are asking different question. How do we produce enough chips? Memory manufacturers can't build fast enough. Nvidia continues shipping every GPU it can make, and hyperscalers keep increasing AI spending. And some analysts now believe this investment cycle could continue for the rest of the decade. So today, let's separate fear from the facts and understand why this AI story may be still be in the early chapters. Why the market is confused. The recent pullback scared many investors. Memory stocks dropped and the AI hardware sold off. Headlines suddenly talk about slowing demand and competition, overbuilding and peak AI. But if you ignore the stock prices and focus only on a company fundamentals, the picture look very different. Order continue growing and factories remain sold out. Customers are still signing the multi-year agreements. This isn't usually not happen when the industry approaching its peak. The new AI bottleneck. A few years ago, GPUs are the biggest limitation. Today, the bottleneck has shifted. Now it's memory. Every advanced AI models requires enormous amount of high bandwidth memory to train and generate the responses. Without enough memory, even the fastest GPUs become less effective. That's why demand isn't just growing; it's multiplying. Part why Micron is no longer a normal chip company. For the decades, investors view Micron as a classic boom and bust businesses. Strong profit followed by the oversupply, followed by the collapsing prices. That cycle repeated over and over. AI may have been written that story. Instead of competing on volume, Micron is now competing on scarcity. Instead of selling to whoever needs memory this quarter, customers are locking in supply years ahead. That's give the company something it's rarely had before. That is visibility, and Wall Street value the visibility. Building supply isn't easy. Some people assume higher prices will quickly solve the shortages. Unfortunately, semiconductors don't work that way. You can't build an advanced memory fab in the 6 months. Construction takes years. Equipment take time to install. Manufacturing will improve gradually. Even after the building is complete, production ramps slowly, and demand, however, doesn't wait. While investors debate about the competition, Nvidia keep expanding its ecosystem. The company isn't only selling the GPUs anymore. It's building networking, software, inferences platform, developer tools, and cloud partnerships. And now even new financing models that help AI cloud providers deploy more Nvidia hardwares. That's how ecosystem becomes stronger over the time. What about the custom AI chips? Google has TPUs, Amazon has Trainium, and Meta continue investing in custom silicon. Does that threaten the Nvidia? Maybe someday. But today, most companies still rely on Nvidia for their most demanding AI workload. Custom chips solve a specific problem. Nvidia provide a complete platform that makes a difference. Ironically, the biggest risk today may not be weak demand, it's maybe the opposite. Demand growing faster than the infrastructure. Power shortage, memory shortage, networking shortage, cooling limitation. These physical constraints could be slow the AI development more than customer interest ever does.